Welcome to Growth Investing Mastery. Today will be our March 2025 portfolio review. And as a reminder, this is not investment advice or recommendations to buy any stocks. Let's look at the topics we'll discuss in this video. First, we'll look at our allocations and returns for the year, and then we'll look at macro and overall strategy. And I want to get into macro and overall strategy this video because the market's been down a lot, and that's had a big impact on returns. Next, we'll get into details of the 10 companies I own, and we'll look at a company I sold this month and the reasons why. And then lastly, we'll take a look at some newly researched companies this month. My allocations for the end of March include AppLovin, symbol app, at 21.7%. Next up, I've got two companies in the 17% range, which are Astera Labs, ALAB, and Paymentus PAY. I've also got two more high confidence positions in Hims & Hers Health, HIMS, at 15.1%, and Reddit, RDDT, at 14.2%. I have only one medium confidence position right now, which is GeneDx, symbol WGS, at 6.9%. And typically I have a lot more medium confidence positions in my portfolio, maybe three or so that would be around the 8 to 10% range. But just the way things have been playing out, I haven't felt comfortable to bump one of these 7 through 10 companies that we're going to discuss next. There's four lower confidence positions, which are Biostem BSEM, Ardelyx ARDX, Cinverse CNVS, and Raspberry Pi RPI.L. Three of those companies are about a 2% position, and the Raspberry Pi is around a 1% position. This month I sold Credo with symbol CRDO, and that was about an 8% position, which I moved that money over to Pay, Reddit, Astera Labs, and GeneDx, and then I had really small adds to Cinverse and Ardelyx. Looking at our results for the year, our portfolio is down 24% year to date, and there's no way to sugarcoat this is not a good result. I've definitely been feeling quite a bit of fear around the macro situation, like most people have. If you listen to some of my psychology videos on investing, then you know that fear is the signal to look into the topic further. And one strategy I like to borrow from The Mental Game of Trading by Jared Tendler is the strategy of injecting logic. And this is when we feel a strong emotion that may not be completely logical. We can use this strategy to look at some logic and apply some data. The bit of logic that I've been finding helpful is that our strategy underperforms in bear markets. It overperforms in flat markets and strongly overperforms in bull markets. And I gathered a few data points or points in time from 2025 already, which validate this logic. When the NASDAQ was up 3% earlier this year, our portfolio was up 28%, significantly beating the NASDAQ. But when the NASDAQ was negative 6%, our portfolio was down 16%. And today, when the NASDAQ was down 8%, our portfolio is down 24%. So we can clearly see that our strategy amplifies the return on the NASDAQ, whether that's to the positive or to the negative. And I put a graph here of my main account. And if you look back all the way at 2024, where the dark bar is, I had a pretty strong run up at the beginning of 24, and then it was flat for almost the entire middle of the year, the 6 months, and then there was a huge run up till 2025. And looking at 2025, we see it started out a bit flat. We had a big run up and then the largest drawdown in the account so far. And one thing that kind of stands out to me though is when we zoom out quite a bit, the line is right about where we were around November 1st or so of last year. So even though it feels like we've had these enormous losses, which we have, but if we look back a little bit, it doesn't look as bad in retrospect. And the cumulative return on the portfolio since January 1st of 2024 is 87%, which is still a strong result. Let's discuss now how this strategy deals with macro. And the strategy doesn't trade around macro. By not trading around macro, we can ignore this aspect completely and it simplifies the approach quite a lot. While the strategy doesn't do any hedging, there's also no leverage, such as margin or options. In that sense, we are balanced in that we're in an only long stock portfolio. And macro is really hard to predict, and it's even harder to know what the price outcomes from macro may be. Looking back at 2020, if we had known in the beginning of the year there would be a global pandemic, many people would predict the stock prices would be way down. However, there's also counterbalances in macro. For example, the Federal Reserve lowered interest rates much faster than anybody thought possible. Additionally, it's challenging to build a disciplined trading strategy around macro if we simply rely on our intuition. A lot of times we may feel fearful, and that'll cause us to make a move, such as going to cash or taking a hedging position. But right now, when we're feeling fearful, staying disciplined is more important than ever. And abandoning our strategy now would be costly and result in a loss of confidence. And to be clear, we shouldn't just have our head in the sand about macro events. We want to be smart and investigate how our companies will adapt to the new macro environment. Let's review our overall strategy now for growth investing mastery. And I'll do a longer video on this topic sometime, but I just wanted to do a quick review right now of how my strategy works. And I like to own 7 to 10 promising growth companies. Sometimes I'll get outside of that range a bit and own maybe 12 or 13, but usually that 13th position is going to be really small or just be a starter position. And I like to focus on the businesses rather than the price of the stock, and that's helpful for getting alpha or edge in the market. I follow a numbers and narrative approach, and that means we want strong, accelerating financials and a compelling story to the company. Our allocations to any individual company are based on our confidence and conviction in that company. One key takeaway is that we don't need all of our companies to succeed. Some of our companies can do poorly in the market and will still get a strong return. We want to diversify into a variety of industries and sectors so that we're not all in on any one trend. We want to also avoid leverage and the risk of ruin. Our strategy doesn't use any anchor position or hedging, and we want to invest with money that we don't need to touch for a while. The strategy stays fully invested, and it's a sustainable investing style for the long term. And I think that's a key point about the sustainability of this investing style. It doesn't induce burnout, and you can go at a slow enough pace that you can do this for a very long time. My top conviction position is AppLovin with symbol app. And the story of this month is there's a new short report yet again. And from investigating it, I feel most of this report is bogus. There were a ton of flaws in this report. The report compared AppLovin to Cheetah Mobile, a fraudulent Chinese company, and the code samples they provided didn't check out at all. On one of the first pages of the report, they had this little Linux script, and you could barely see it. It was tiny text. But if you look at what the script was doing, it was uploading and deleting a zip file and moving it, and it was just repeating that action over and over again. And the really weird thing was the timestamp was dated back to May of 2024 when the AppLovin web pilot didn't even exist. So this whole thing seems like a fake report, essentially. The latest short report posted this YouTube video, which was very grainy, and it was hard to see what was going on in the app. And there was no volume to it, so it was a very low quality production. Looking back at the Fuzzy Panda report, another short report, they said, no one seems to know what AppLovin does. And then it links to a Twitter post that has 500 votes. 75% showed they don't know the product. And I thought this was a really weird take for them to have, because unless you're in mobile gaming, you probably wouldn't know what AppLovin is, or maybe if you're an investor, you may have heard of AppLovin. But outside of that, you probably wouldn't have heard of the company. And I would also say there's plenty of companies like this. For example, ServiceNow is a company where if you're in tech, you've probably heard of ServiceNow, or if you're an investor, you've heard of ServiceNow. But otherwise, it may just be a no-name company too. I'm not putting much weight on either of these short reports. And stepping back for a moment, the fundamentals are as strong as ever on AppLovin. I don't believe they're violating any rules in the App Store or the Google Play Store, and I'm expecting the e-commerce pilot to become generally available soon, and that will boost revenue and earnings quite a lot. The CEO has done a pretty good job defending the company in his latest statements. First, the CEO did a blog post where he refuted the short report and explained why their company doesn't violate any of the rules mentioned in the report. Secondly, the company retained some legal counsel on the multiple short reports and the intentional crashing of the price. So that seems like a reasonable move for them to make. Additionally, they released some more technical blogs, not from the CEO, but from an employee. And they're showing screenshots and going through clicks and showing how everything with their app is completely legal. And I like they're going on the offense a bit here and giving people more of an education on how their product works overall. I've recently been doing some tangential reading to investing and finding good companies. I'm reading this book, Good to Great, which is from 2001, and it's about how good companies go to great companies. And when they did a study of leaders, here's what they found. It says the good to great leaders seem to come from Mars, self-effacing, quiet, reserved, even shy. These leaders are a paradoxical blend of personal humility and professional will. They are more like Lincoln and Socrates than Patton or Caesar. The CEO, Adam Ferogi of AppLovin, is a great leader because he's getting incredible results for this company. It's one of the most profitable software companies of all time, and it's running at an incredible scale right now. The next highest conviction position I have is Astera Labs, ALAB. And the recent investor conferences I review have increased my confidence in this company. They said that DeepSeek is acting as a catalyst rather than a drag on the business. And I also looked into Marvell's earnings. I had seen in the financial media that Marvell had a very poor quarter on AI spend. And that was pretty concerning being an Astera investor because I would expect the industry to still be strong. Reviewing Marvell's earnings, I found nothing wrong with the AI spend. In fact, everywhere they said the AI spend was really strong. It was their more legacy business which was having some challenges along the way. Many of Astera's products are doing large ramps in the second half of the year. For example, Scorpio, the network switch, is supposed to ramp up big in the second half. Additionally, the Aries product line is supposed to ramp up as well. And Aries is their current bestseller, so that's good to hear their leading product is going to be selling well. And I watched NVIDIA's GTC conference, and at first I was a little concerned because there's a lot of new products like photonics, which I thought might disrupt Astera. And when I asked AI about these photonics and other products, it said that the newer products NVIDIA has are mostly complementary. I actually couldn't even really get it to say that they're competing that much, which is a good sign. The last earnings report demonstrated the continuation of accelerating financials and a strong narrative. However, the stock has sold off dramatically. Yet the business seems to be doing better than ever, and they aren't seeing any slowdown, it seems like. Our strategy for now is going to be to just hold to the next earnings. If it dips really low, there might be some opportunities to add as well. Paymentus is my third highest conviction position with symbol pay. The top end of the revenue guide was 220 million on their last earnings, but they landed at 258 million, which is up 56% year over year. And that actually beats the guidance by 17%, which is a really incredible beat for getting above the top end of the guidance. They beat by a net of 38 million, so they got an extra 38 million of revenue that they weren't projecting for. It's now the second quarter in a row where Paymentus has had a lot of large enterprises sign on. And the previous quarter, they mentioned they had a lot of enterprises sign on, but they said they weren't sure if the trend was going to continue. And this earnings report really validated for me the large enterprises are continuing to ramp up and really wanting to get on this platform fast. I believe this company is being somewhat cautious on their guidance, and they give very conservative guides. I think the market may be underestimating Paymentus a bit because they're in the payment space, and a lot of other payment providers didn't really have real innovation before, and they might just be serving someone at a kiosk. And Paymentus is a bit different because they're in the enterprise space. So I do feel this company's a bit misunderstood right now. They are a quietly executing company, and I see them similar to AppLovin in that sense. It's a company a lot of people haven't heard of, but they're putting up incredible numbers. One advantage for this company right now is almost all their business is US based. So I don't believe this company will be dealing with tariffs or anything like that. And I haven't heard anything from management saying they see any problems with the current economic environment. The market cap is still just 3.3 billion. And if you recall, they had almost 260 million of revenue this past quarter. So this company does seem to be getting quite cheap. Looking at the run rate price of sales, it's 3.2 right now. And that compares to other SaaS vendors like Cloudflare or CrowdStrike, which have closer to something like 20 for this metric. Hims and Hers Health, symbol Hims, may also be a company that has an advantage right now with US sourcing. They have three pharmacies they own in Ohio, Arizona, and California. They made some really smart acquisitions a few years ago with this apostrophe pharmacy, I believe it's called, and a couple other pharmacies where they bought the entire tech and warehouses and entire space, and their square footage has been expanding recently. The company uses all these pharmacies to build their own product in-house, and they can scale up. As the company's mentioned, they want to get up to 10 million individual users. HIMS has lots of solutions for GLPs, and one GLP recently went generic. So HIMS can sell that one no matter what happens with any patents or things like that. Additionally, there's some oral forms of pills which HIMS has and are pretty reliable compared to GLPs. The company can sell brand name GLPs as well. Eli Lilly and Roman have been competing with HIMS recently, as Eli Lilly does a direct distribution of its GLPs through that competing platform. Recently, HIMS presented at the Morgan Stanley Technology Conference in early March, and I've been meaning to check out that conference. I haven't reviewed that one yet. HIMS is another company where the run rate price to sales seems pretty reasonable. It comes in at 3.4. And normally I don't look at valuations each month like this, but with the market being down, it's worthwhile seeing what feels like a good value here. Another high conviction position for me is the company Reddit with symbol RDDT. And I recently did a video on this channel for Reddit introducing the company and gave a lot of details about it. Since that video came out, there's been more evidence that the Twitter CEO has been pressuring the Reddit CEO, and a lot of users are upset at that censorship because the Reddit CEO shut down some of the discussion about the Twitter CEO. And something to know about Reddit is the users are complaining a lot, and users are almost always nostalgic for old Reddit, as I've seen so many different times where someone's saying the old Reddit was so much better, or this or that, or they're censoring too much. And mostly Reddit's trying to prevent violent content from spreading on there, so they still don't censor very much from what I've seen. The most impressive part about this business right now, in my view, is that gap profitability has been increasing a lot. And if we look sequentially, gap EBITDA went from 11 million to 57 million sequentially, which is a huge jump up in just one quarter. Net income also went from 30 million to 71 million, also a very big jump. And the CEO has already hinted that they see strong Q1 numbers. So he's letting us know the next quarter is going to be strong. GeneDx with symbol WGS is a medium conviction position, and the stock price has held up pretty well since their last earnings report. Before the earnings, it was in the mid 70s and it's hovering around $90 to $100 now. The company was recently at the TD Cowen Healthcare Conference. I haven't reviewed that report yet, but it's good to see a company as small as GeneDx going on tour and doing these important conferences to get word out about their business. The biggest standout on GeneDx to me is how strong the sequential numbers are. Revenue went from 77 million to 96 million in just one quarter, and EBITDA went from negative 2 million to positive 15 million, or a swing of 17 million. Net income went from negative 8 million to positive 5 million quarter over quarter. Ardelyx with symbol ARDX is a low confidence position for me, and I have an introduction video on this company. My biggest concern right now is Medicare for the kidney medication. They mentioned that certain parts of their drug may not be covered by Medicare, and I'm trying to fully process the implications there. That concern is still keeping me from turning this into a medium confidence position, but there's a lot of things I do like about this business. My favorite detail about the company is both medications treat really common conditions. For IBS, there's 6 million plus prescriptions in the US alone, and the kidney medication is treating a patient pool of over 500,000 patients at any one time. The market cap is still really small for this company at 1.2 billion, and the company is already profitable. Biostem with symbol BSEM is another low confidence position for me. And there hasn't really been a lot of significant news since their last preliminary report. However, the stock has gone down massively, and that's a big concern for me. When the general market was going down, this company was going down too. And that was kind of to be expected. But there were a few bounce back days, and a lot of those days Biostem was down again. And I'm trying to understand what's going on. And I kind of wondering if I made some mistake not trimming a bit earlier too. The company is trying to get uplisted on NASDAQ because they're on the pink sheets. And normally I don't invest in pink sheets companies, but this company already did one upgrade on the OTC to go to a more sophisticated OTC. And most of their investor relations and filings seem completely like a NASDAQ company would do. I'm not sure of the timeline though when the NASDAQ uplisting would happen or not. And what I'm starting to wonder is if investors have bailed on this one because they thought the NASDAQ uplisting should have already come. However, there might be some complications at the SEC for political reasons right now. The other thing I found, which is a little bit strange about this company, is they're reporting Q4 of 2024 in a couple days this week. I believe it's on April 2nd. And I'm not sure why it's taking so long to report Q4, because normally companies report Q4 in mid-February or early March. However, the financials are really incredible for this company, and it leads me to wonder if maybe it's too good to be true now. So I do have really a lot of doubts about this company. However, since they're reporting so soon, I'm going to stay in them and then reevaluate after the earnings. Previously, they had reported 103 million of pre-announced quarterly revenue, and they're already GAAP profitable, which I expect them to continue. The market cap is somehow just 140 million, and the run rate price to sales would be 0.34, which is tiny. So our strategy now is going to be to reevaluate on the earnings. And we might do a little retrospect if we made some mistake here, not trimming as it was going down so significantly. Cinverse with symbol CNVS is a low confidence position for me. And it's definitely the most unique of the investments I have right now. The company released a horror movie called Terrifier 3, and it put up incredible box office numbers. This screenshot at the bottom is actually from IMDb, and it shows the budget for the movie was $2 million. Yet the opening weekend in US and Canada grossed $19 million. And together, total for US and Canada, it was $54 million gross, while worldwide they grossed $90 million. To summarize, they spent 2 million and they got 90 million in revenue and a lot of earnings from that as well. So it's really impressive numbers for one movie. However, it is one of my big concerns this type of revenue may not be recurring. They've had a ton of impressive press releases recently. One was a partnership with the Trade Desk where they're integrating the Cinverse tech platform. Also, I found another story from last year where they announced they were using AppLovin's rural product on ad-supported channels. It's good to see Cineverse is making these partnerships with companies like App and the Trade Desk, both really popular growth stocks themselves, which have impressive platforms. And their Screenbox, which is a streaming platform, has been up 18% since Terrifier 3 launched in February. The company has a number of products besides just making movies, and that includes subscription streaming services, where they have categories of horror, anime, comedy, crime, and romance. And Cineverse is launching the Wits podcast network. Their podcast revenue is up 39% year over year. I'm still not sure what base their podcast revenue is coming from. I think it's pretty small, but it's still good to see an acceleration in a number like that. They're also releasing a novel based on Terrifier 3. I'm not really too sure about that line of business or how profitable that could be, so, but it's something to maybe think about. And they have a new movie coming out called The Toxic Avenger, and it seems like it has a pretty good cast: Peter Dinklage, Kevin Bacon, Elijah Wood. They seem to be able to get these big name actors on board with their movies. And the company has a tiny market cap of just $50 million. That market cap makes it one of the most risky investments I have. And I do have this concern I mentioned that it might be hit or miss with these movies, but overall, I really like the story of this company. And it might be a little bit of a story stock because sequentially revenue is going to be down next quarter likely because they don't have a hit movie. So we'll see how this one goes. I'll keep a close eye on it. The last company I own is Raspberry Pi with symbol RPI.L, which trades on the London Exchange. I actually set up an interactive brokers account this month to be able to potentially pay smaller fees to transact with this company. Previously, I'd mentioned there was a 0.75% fee, and that's on Schwab, but there's other discount brokers who have lower price cost commission and transaction fees. Since reviewing Raspberry Pi last time, I learned there's a new competitor called Orange Pi, which is made in China and it has faster performance, but it has worse support as well. I was looking on Reddit and the discussion seems pretty split on which is better. So the Raspberry Pi has better drivers, but sometimes if you already know what you want to do, the Orange Pi might be useful as well. There was one key factor in the discussion where a few people said Raspberry Pis always seem to be sold out. So I'm not sure what to make of that, whether that's a good thing or a bad thing that the company is selling out, or maybe they're having trouble scaling up as well. The company is reporting later this week, so we're going to reevaluate again on the next earnings and see how it went. There's one company I sold this month, which was a medium confidence position, and that was Credo with symbol CRDO. Their earnings report revealed 86% of their revenue comes from Amazon now. There was no prior mention of upcoming customer concentration, and I feel that management may have obscured this fact a bit about the concentration. One of the analysts pointed out that other customers dropped off significantly in the quarter. I use the FinChat app sometimes, and they have some really interesting KPIs they show in the data. And there was a few very surprising ones for Credo. In the USA, revenue went from 22 million last quarter to 8 million, a significant drop off. But Hong Kong revenue went from 30 million to 93 million. Revenue in China went from 14 million to 25 million. And this is where I got a bit confused. So, if all the revenue is coming from Amazon, is that meaning that Amazon is building out its Asian data centers and they're using Credo as their main supplier? I think that's how I interpret that data. The real red flag here, though, is that USA revenue cratered, which is still the biggest market for AI, even though Asia is growing fast. And I don't understand why management didn't warn us about this customer concentration ahead of time. For me, that's two red flags, so it's an easy sell from here. There's three companies I researched this past month, which seem pretty interesting. I don't have a position in any of these companies, but they might be worth looking at in the future. The first company is called MDA Space, and they trade on the Toronto Exchange. They're growing revenue at 69% year over year with 241 million of revenue, and they're already profitable. The company is based in Ontario, and they work with NASA. Recently, they got a $1.1 billion contract with Global Star, and their backlog is over 5 billion, which they expect to take 3 years to process. My big concern here is the trade war, and the US makes up about a third of revenue. The stock traded down a bit on tariff news. On the other hand, they did mention they might get new clients in Europe, which could be potential upside. And that's why I might want to keep an eye on this company. The next company I looked into is called Cytomx Therapeutics, and the symbol is CTMX. They are a company which makes a biologic, and it remains active in healthy tissues, but it only activates in cancerous cells. This is an absolutely tiny company as well. They have only a $50 million market cap, but somehow they have revenue of 38 million and net income of 18 million. Payments come from partnerships and milestones, and they have a lot of impressive partners, such as Amgen and Moderna. One concern I have is they mentioned there's a discontinuation of their product CX904 with Amgen. And when I was asking AI about this, they also mentioned the workforce cut of 40% suggests the company might be doing capital conservation. My other concern is their drugs are in phase one only, and it's a very long ramp towards FDA approval. However, it's pretty rare to see a company with a 50 million market cap and 38 million of revenue being profitable. So it seems like there could be some good value here. I might want to see what they can deliver on future quarters. The last company that looked interesting to me is called Nova Limited, NVMI. And they're based out of Israel. They have 45% revenue growth at 195 million. They make metrology and process control systems for semiconductors. They serve a lot of chip makers, including TSMC, Samsung, and Micron. My biggest concern is they get a lot of revenue from China, which can be a kind of murky market on export controls. And the market cap for this company is already 5.5 billion. So I don't think it's a cheap company. Let's conclude this portfolio summary. So it was definitely a tough month for results. But if we zoom out on our graph a bit more, it's still looking pretty good. The company numbers that got reported remained really strong this past quarter. And I ended up only selling one company through all the turmoil. So that's pretty good results in terms of company results and not trying to follow the price too much. We're going to continue to monitor the trade war and tariff implications and see how that affects each individual company. But we're not going to trade off macro, even if it's really tempting right now. And I've got a few upcoming videos planned. One is going to be about portfolio allocation. As I saw in the comments, somebody was interested in this topic. And I'd also been thinking about making a video on the ideal number of stocks and some game theory behind that. I'd also like to look at an overall strategy video for the channel and try and give a little comprehensive review in a quick review video. I've mentioned before a couple of times on psychology videos the trading in the zone material, and I'd like to look through that again and adapt it a bit for a more investor focused use case. Lastly, if BSEM or RPI.L have a strong earnings, a real outperformance, I might end up doing a video on that. But if it's a tepid report or just not that great a report, I'll probably pass on that. If you like the video, leave me a like below, and definitely feel free to leave comments, even if you're just a beginner or if you're an experienced investor. Any feedback is welcome. Thank you.